To understand the tax code is basically to give yourself some cheats, some advanced leverage on how to keep your money. Reality is the tax code is a giant game of Monopoly. You still can win. You just have to know the rules.
Are you a paper millionaire? What does that mean? And what can you do about it? Because truthfully, if you are a paper millionaire, you do want to be taking some action items, at least from what I'm seeing here, Mike. Many people have gotten to this point. They have saved their whole lives. They've worked, they've sacrificed. They hit $1 million. Now the kids are out of the house. They want to downsize. They paid the house off and it's worth $2 million. I don't know what to do with that kind of money. Well, you need to address it because the question is, are you really worth that amount of money? The response is sort of. This is what a paper millionaire is. On paper, you're worth this much. So when you get to your retirement and you sell that multi-million-dollar house or business, in that particular year, the IRS turns your paper wealth into real income. And that's when folks in this space can get just tasered by a big tax bill that they never saw coming or planned for. So the question for you then is, Mike, what can we do, if anything, ahead of time to soften that blow?
There's a lot. First of all, we have to realize that, paper millionaire is a very, very real thing. It's almost like it goes back to that book, the Millionaire Next Door. For a long time, we always thought of a millionaire as like this ridiculously crazy thing. That's because the average house,
lifestyles of the rich and famous, that kind of thing. Yeah.
Well, it's like the houses on average were worth like 150 grand and your 401k was 400 grand. And so then all of a sudden it's like, all right, I got $500,000, 550. But now most people's houses are worth $400,000 to $600,000 or $700,000, like in the middle, Then on top of that, most 401ks are running up quite a bit higher. So $1 million on paper is not that hard to get to, especially when you roll in. And then if you do have a business, and the way business valuations and exits are happening right now, it is not hard to get to a couple $1 million worth of valuation. But when we start looking at how much I actually own, like what is mine, how should I be doing things? First of all, there's a handful of strategies. One, there's how much you're worth, and there's the other one is how much you're taxed on. Right now, people are going to hate this, and some people are going to love this. But the reality is the tax code is a giant game of Monopoly. And we got to figure out how to move the pieces and make the right decisions and know when to buy, know when to sell, know when to hold, know when to build. And that is the whole thing. So understanding the tax code and how you can keep as much of your net worth as possible is the challenge. If you have $1 million in your 401k and you take it all out, you're not getting $1 million. You're going to get 638,000 or whatever the number is. If you win $1 million lottery, and you take the lump sum, you are not getting the $1 million. You're getting way less than that. So to understand the tax code is basically to give yourself some cheats, some advanced leverage on how to keep your money. One of the biggest things is you can, before you do anything, know the consequences, right? So if I'm thinking about getting, and it's funny, we deal with people who exit businesses all the time. And when they talk about exiting a business, I always say, well, how are you getting your payout? Well, I'm going to get this, then this, then this. All right. Well, then we need to try and ladder this unique ways. Sometimes you can help the buyer as you're helping yourself. So I had a friend, he was buying a company. He was buying a landscape company. It was a very successful, but it had huge contracts. Like because we're in Michigan. So they had all the plow contracts for like Walmart and Target and a couple other places in the area. So those are big plowing contracts. And at the same time, they had a ton of commercial mowing contracts. So year round, he was busy and a lot of gear. Like when you're plowing a Walmart parking lot, you're not doing that with a truck and a blade on the front. He's got giant tractors and all the stuff he's doing. And so he's using big buckets. And so this is a multi-million dollar purchase. And he's doing this while he owns just a one-man operation landscape company. He just has his truck, his mower, him and his wife are out mowing. I said 2-man, right? They're out mowing and trimming and doing it. And he was like, I got this unbelievable chance. And the guy who's selling the company, he wants out of the company, but doesn't really need the money that much. So we structured a 5-pay pension, and a 5-pay in a way that he was able to take 20% of the proceeds of the company for 5 years, and pay it out. So we kind of said, what is the fixed valuation? You sell it. And then from there, he was able to pay the guy out of proceeds as a profit sharing distribution. And because he was allowed to do it, he gave the guy a higher payout. So if he was, let's just use an example. If it was going to cost him $1 million to buy this company. All right. Then in theory, if I paid over 5 years, I want to pay $200,000 a year, right? So it's $1 million divided by 5 payments. But nobody says, give me my $1 million, or if I have to take it over 5 years, pay me more. So we worked out a way where we were able to do the structured plan, save money in taxes for both of them. And yet the guy who bought the company was able to buy it without taking a loan. The guy who sold the company was able to get about 25% more for the company than he would have had he taken a lump sum. It was a win-win. But it's because we went through and advanced and built this structure. We knew what needed to happen. For people who are retiring and they say, I don't have a company, I just have my 401k. All right. How and when you take money out of that account is going to determine how much you're taxed. We can do it in a way where you get the income you need without taking major tax hits. And then we look at how much you're scheduled to pay in taxes over the next 20, 25 years of your life, and how can we reduce it? If you know the tax code and you know the rules and you know what you want life to look like, you can build a plan that says, here's how it benefits me more than it benefits the government. We can't avoid paying taxes. We can't cut taxes out of our life completely. However, if you own a company, even if you own like a little LLC and you do some side hobby job, we can do an awful lot of tax strategy that says, all right, here's how I can minimize my taxes and keep a lot more of what I've earned. So again, whether it's owning a company, another one is selling your house. I'm going to downsize and move into somewhere else. There are strategies to, mitigate that. There's a lot of it you don't have to pay taxes on. There's a certain amount. If it's your home, you've lived there more than 2 years, you don't have to pay taxes up to a certain dollar amount. However, once you go over that dollar amount, there's taxes owed. So does it make sense to take a slightly less offer if you pay no taxes on it? There are some things in that, right? So that's where we try to work through it. And also like, hey, should I sell it now? We had one of our clients, he is a house flipper. And that's his thing. He buys house. Well, then he had bought a house, flipped it, and sold it. The same year, he bought another house and flipped it and was about to sell it. So he was going to sell 2 in the same year. And it was going to be a bad tax year because he didn't have to put much into the expenses for the flip. And even though normally we can get rid of a lot of income, we couldn't do it there. So he actually wrote a contract. He rented it to the new buyer for 1 month for a super discounted price. So instead of the guy buying it in December, he rented it to him in December, sold it to him in January.
Got it.
And that way the tax rolled over 1 year. We saved about $25,000 in taxes doing it that way. So, and it's all just creative thought, right? Like, well, and he came to me, he goes, I don't know what to do here. I said, well, let's talk it through. What if you gave him a free month of rent? Give him 1 month free rent. It's going to save you 25 grand in taxes. He goes, I can't do a free month of rent. I said, okay, do it for $500 then. So he rented it to him for $500 with the promise that if a guy paid $500, he'll sell it. And so they moved the closing back. It took some negotiation. The realtor didn't like it. People didn't like it, but we made it happen. Right. But I'm like, yeah.
Thinking about what you just pointed out, I'm thinking about a person that is close to retirement and maybe they listen to this podcast or they are working with somebody or just DIYing the idea of a Roth conversion and they're trying to downsize. Is that also the opportunity, tax opportunities, or perhaps self-inflicted tax penalties? Is that another space? If you do, be careful when you're doing Roth conversions and maybe selling your house at a certain point in the same year.
Yep, because they all your adjusted gross income all kind of rolls together. Okay. So we want to make sure that our taxes, and we also, like when you're in retirement, how much you pay for your Medicare premiums is affected by your tax return 2 years ago. Right. 2 years ago. Okay. So we had someone who came into us not too long ago, and actually about a week and a half ago. And their big thing was they said, I don't know why my Medicare premiums just jumped. And I said, well, it's 2026, your premiums just jumped. And then and as a result, their Social Security benefits went down. It all started with that. Why did I take a Social Security benefit cut when every year we're supposed to get a pay raise? And I went through and they brought in their documentation. I said, well, it says your Medicare premiums went up. What did you do 2 years ago? They said, I don't know. I said, did you do Roth conversion 2 years ago? Oh yeah, we did about $60,000 of Roth conversion. Okay. Well, when you did that $60,000, it jumped you to a next Medicare premium bracket. So they increased your Medicare by, $50 a month and each. So what they did is they started withholding that from your Social Security benefits. But they didn't catch it January or February. So they had to dock you more significantly for the balance of the year. Like it was a whole thing. Right.
Is it come back down or are they stuck?
It resets every year. So like in 2024, they did Roth conversion. So 2026, their Social Security took a hit because their Medicare premiums went up and they're withholding it. Well, next year, if they didn't do Roth and they didn't do any Roth conversion in 2025, so in 2027, you go back to a lower Medicare premium, your Social Security benefits go back, it resets. But they didn't realize in 24 what it was going to do in 26. It still was worth it, by the way. a $60,000 Roth conversion, and it basically costs you $1,200 that year in Medicare premiums. Okay. It still is worth it because they're young. They're in their older 60s. So as long as they live another 5 to 10 years, the returns they'll get in that Roth far outweigh the $1,200 they paid. But it sure stinks when you get that surprise letter. So again, it still made sense, but they would have felt better had they known in 2024, hey, just heads up, we need a bookmark in our mind in 2 years, our Medicare is going to get more expensive. So just understanding the rules, Roth conversion, selling your home, selling some non-qualified stocks, there's stuff that you have, everything has these tax rules. And we got a lot of clients who, I inherited these stock from my parents 10, 12 years ago, and now it's, $2 million, $2.5 million. Yep. And if you sell any of it, it's heavily taxable. So we got to use tax harvesting strategies or step up in cost basis at inheritance strategies or collateralized loan strategies. Like there's a lot of stuff we can do, but just know the rules, play by the rules, win within the rules. It's the same thing we always say about taxes. Giant game of Monopoly, you still can win. You just have to know the rules so you don't end up drawing a luxury tax card or, you don't end up landing on a spot that really hurts you.
Yeah. Well, Mike, you and your team obviously here to help folks figure out what opportunities, strategies might apply to you listening to this podcast, watching this video, how it might apply to you. If you are a millionaire on paper, get to work making sure you're keeping as much of that money as possible. Mike's here to help. Find us at michigansretirementcoach.com or just click on the links we got posted in the show notes.